Good afternoon, everybody. I see 32 people on board already, so let me get started. My name is Andy Profit. I'm the old codger here who started the income SIG here in Portland, Oregon, and so um, we're going on to new and better things here. Todd Blinkenstaff will take over from me. I guess I'm obliged to share with you a disclaimer. Hold on. Let me bring that up and show that to you. We are a part of the AAI organization, as everybody knows, and we're the Portland chapter. And this is our regular disclaimer. I think everybody is familiar with this. Anything you see and hear here should be taken with a grain of salt, and for entertainment purposes only. We're not here to give you financial advice. So please do so accordingly. So I'm going to stop sharing, and then I'm going to turn this over to Todd Blinkenstaff. Todd, I'm going to stop sharing here in a minute here. And you're ready, free to go, as they say.
Okay. I hope everyone can hear me. Good afternoon, everyone. We appreciate you joining us for this presentation of the revamped income and cash flow SIG group meeting that we run from Portland, Oregon. As Andy mentioned, he started this program and ran it for years, and we're just kind of resurrecting it. Andy wanted to step back from a role of coordinating all of the meetings, and so we took some time to regroup and replan the meeting format, which we've done. And so we're into I guess a new school year here, and so we're going with these meetings. I think everyone's probably seen the email that talks about the format. Whereas we used to do these meetings and this includes online, and predominantly we've been doing it online for the last 4 years or so, and we're doing these on Sundays. We moved those to Thursday at this time, and because we're trying to reach not just the Portland chapter, but also other chapters around the country, we're encouraging them to participate on our calls as well, and particularly those investors that are have an interest in income and cash flow oriented investments. And as we mentioned in one of our communications, and we think there's a lot of potential people to do that, because most people, or the average age or median age for members of AAII is actually 72 years. And so a lot of the majority of the people are either in retirement or contemplating or looking forward. And we also thought that, given the fact that we've had a lot of turbulence in the markets over the last few years, and the fact that we're in a rising interest rate environment for the first time in decades, literally, and that it's a new environment, and so we need to look at some ways where we can help share information, hopefully educate participants in the meetings with ideas for generating income and cash flow from their portfolios to help fund their retirement and other interests. So that's kind of what we're designed to do. And we have a variety of different investments that we're planning on talking about in these sessions. I know Andy's had a lot of expertise in dividend and dividend growth investing. He's been kind to share that with us in past meetings, but we're also looking at a variety of cash flow oriented investments, not to include REITs, a variety of different types of bonds, limited partnerships. And so with the new meeting format, again, we're going to be meeting on a monthly basis, and we're scheduling these meetings to run for about an hour and a half max. And that's our target anyway, but we're going to be flexible on that. And they may go longer, they may go shorter. And of course, people have flexibility when they sign off if they need to. And but one other thing that we're doing for this meeting format now is we've added a new component, and we're excited to include Gilbert Ho, who's a member of the Silicon Valley um, uh, chapter of AAII and has been doing presentations for their chapter on the economy and the financial markets. Just as kind of an overview to get the meetings going, because there's always, as we all know, so much new information with respect to the financial markets all the time. And so because we're meeting monthly, we're planning on starting off the meetings after an intro like this, where Gilbert's going to talk about what's new in terms and significant from his viewpoint with respect to news regarding the economy and the financial markets. And and then we're going to proceed after that to the main topic for this. And for this particular meeting, we're going to be talking about investing, how to invest in a higher for longer interest rate environment. Because as everyone's aware, we've had a major move upward in interest rates over the last couple of years, and it has changed the environment in terms of potential investments. So that's going to be the main topic. But what we're going to do here is start the meeting with Gilbert, and again, want to say thank you again for Andy for being here and for setting the whole stage and running this SIG group for many years, successfully for years. And I wanted to talk a little bit about Gilbert's bio. Again, he's a lifetime member of AAI, co-host of AAI's Silicon Valley Computerized Investing special interest group. That's one of the special interest groups they have there, like we have this one here. And he's a retired software engineer with development and management experience at various startups and large companies. So he has a very rich background in technology. And he's passionate about learning in macroeconomics and investing strategies. And now he's retired, he presumably has more time to do so. And Gilbert also has an MS in computer science and a BS in electrical engineering. So great quantitative and science-based skill sets to bring to the table here. And so, so without further ado, I think I'll hand the microphone over to Gilbert, and then he's got a presentation that he's going to be presenting for us going forward. So take it away,
Todd.
Gilbert.
Hi, this presentation is a quick overview of some economic data. I use them to help myself to get a grasp on the market and macroeconomy. Over the years, I learned that economy is not a physical science. Patterns in economic data serve to raise the probability only. They do not dictate the future. Please understand that all information provided and opinions expressed here are for entertainment and educational purpose only. We do not provide any advice here. If you find some information interesting and want to go to the source, most slides have their relevant URLs on the title bar. And economic data I use here generally come from Federal Reserve, also known as FRED, F-R-E-D. In addition to the presentation date on the lower left corner of the slides, I also put the date of last update at the upper right corner of each slide to show the freshness of the data. So one of the most important events in the financial world that happened lately was the two-day FOMC meeting that ended on November 1st. At the meeting, they have decided to hold the federal funds rate unchanged. It's a pause. And while continuing the quantitative tightening to reduce the size of the balance sheet. An interesting quote here is the wording that Chairman Powell used in the press conference. You can see in the second paragraph on the lower half. And he said, we are not confident that we haven't, but we are not confident that we have. He's trying to express the uncertainty of interest rate policy. The futures market of federal funds is anticipating continued pause for the next 3 FOMC meetings. And this is from the upper left chart. It also expect 4 rate cut in 2024, and that's amazing. However, these are just expectations expressed in futures contract positions. Like any prediction of the future, they may or may not be what it turns out to be. Looking at the longer term chart on the lower part of the slide, you can see that generally the federal funds rate is higher than the core PCE inflation rate, except for the last 15 years after the great financial crisis, also known as GFC. It is only natural with the recent rapid rise of inflation and dramatic interest rate hike that the expectation swings back to before the GFC. Here are the yield differences. We've been hearing these for quite a while now. The top chart shows the usual yield diversion, which is derived by taking the long rate minus the short rate. So either 10-year T-bond minus 2-year T-bond or 10-year T-bond minus 3 months T-bill. The lower chart shows a similar inversion. It is the short rate minus the ultra short rate. So it is the 2-year T-bond minus the Fed fund. This is why you hear people on Wall Street saying there may be a recession next year, because based on some past occurrences, that's exactly what happened when yield differences are negative. Now, on this slide, the lower left chart is the yield curve. The yield curve was in normal backwardation until early 2022. Backwardation means long term is higher than the short term. That is the normal condition. Once the Fed started its rapid interest rate hike in March 2022, the curve inverted. It is this classical inverted yield curve that got many economists predicting impending recession. An important but less emphasized monetary policy here is the quantitative tightening. And QT, as they call, is trying to drain the excess reserve from prior quantitative easing, QE. So the rough history of QE and QT are as follows. During the 2008 financial crisis, the Fed has injected $4 trillion of QE into the balance sheet. The attempt to drain that QE started in 2018, but stopped shortly after Trump attempted to fire Powell for raising rate and shrinking balance sheet. Then we had a COVID, and another $4 trillion of QE were injected. And so the Fed balance sheet reached incredible $9 trillion. So the last attempt to drain the QE started in 2022, last year. To give you an idea of the sizes, M2 is about 21 quadrillion. So that is about 2,500 times bigger than the Fed balance sheet. Anyways, so far the Fed has reduced a little more than 1 trillion from the balance sheet, and that is 25% what they put in during COVID. At the speed the Fed has announced, it will take 4 years to drain the latest 4 trillion. The way these reductions are made is by not reinvesting matured treasuries. So basically, they're not buying new ones. The impact is the bond market lost a big buyer. That must have some impact to the demand and supply balance. So it is not surprising that we saw 10-year treasury spike to 5% when the Treasury Department was selling huge quantity of bonds earlier. So far, we have looked at the monetary policies and interest rates. Next, we'll look at some factors impacting inflation. Because we import a lot of stuff, the strength of the strength of the US dollar is an important factor in inflation trend. This chart shows currently the dollar is relatively strong. So we can buy cheaply from abroad, and that is a good thing for fighting inflation. Now, we also try to peek into the future inflation trends by looking at the trends in commodity futures. It seems these selected commodity prices are generally calm. The producer price index, the import price index, and the export price index all had a huge drop year over year recently. They have rebounded a little bit, but hopefully they will stay low. On the employment side, we can see that the trend is normalizing and the wage inflation is cooling, which is the upper left corner. Now, job openings, the purple line, shows a healthy job market for workers, because for each person looking for a job, there are more than one available. And looking at the numbers like the hires, the green line, when it is above the separations, the red line, the economy is generally healthy. The initial unemployment claims chart on the upper right corner shows the labor market is healthy, because these numbers are really very low historically. And the upper left chart is Portland area employment numbers. Oregon is following the national trend, but counties are recovering at different speed, as one would expect. The lower chart shows employment of temporary help. This chart is like the yield curve that worked very well in the past. And so now it's flash red again, and that made people concerned about coming recession, I'm sorry. Now, retail sales number is a lagging indicator. Here we pair it with the University of Michigan consumer sentiment to highlight the pattern preceding the last two big recessions. And I have circled that here. In early 2020, the consumer sentiment signaled a very brief COVID recession, but it started to recover quickly. Then it dropped again until the Fed started raising the rate. The divergence between the two data series was significant in 2000 and 2008, right before the recession. But so far, we have this divergence, but there's no sign of recession. And both are moving up in tandem again. So that's a surprise to me. The lower chart shows the auto sales and inventory to sales ratio. When inventory is less than sales, the price is usually firm. So it is good for fighting inflation now that the ratio is moving above 1 again. Four charts here, but if you look at the upper left one, which is the ISM PMI, it used to be a reliable indicator whenever it's below 50, which predict contraction. But it has been doing that for a year now. And again, we're waiting. With regard to GDP, quarter to quarter, Q3 was very strong. But I showed the year-over-year chart on the lower left. And it seems like we're back to the normal range. So since 1987, the Fed has been fighting financial crisis by lowering rates and flooding the market with liquidity. Eventually, it becomes the massive QEs. Looking at these 4 different indicators of the financial system state, all seems normal. So there's no rate cut due to financial crisis in sight, which is a good thing, sort of. Now, the 4 important inflation numbers are at the top on the slide. The core PCE index is what the Fed is looking at. When they say the target is 2%, they meant the core PCE at 2%. Currently, it is 3.68%. And by the way, it peaked in February 2022 at 5.57%. The lower four chart shows Cleveland Fed projection versus the actual. Notice that the two PCI numbers are not seasonally adjusted, so they stay the same once they are announced. And so the prediction looks pretty consistent. But the PCE numbers are seasonally adjusted, so they change from time to time, which make the prediction look a little bit inconsistent. As mentioned before, the leading economic indicator has been very reliable, going all the way back to the 1970s. But the signal turned negative on August 2022, about 15 months ago. It seems that we will have a new record on how early it signals danger ahead if recession happens soon. And if we have soft landing next year, we will have broken quite a few previously reliable leading indicators. The Fed polls bank loan officers to gauge bank lending practices and credit market condition every quarter. The information from this survey actually influences the formulation of monetary policy. Since 1990, when they started to collect data, the recession followed when a higher percentage of banks are tightening lending standard. And like yield curve and other things, this old faithful has predicted a recession since late 2022. Now, this slide helps to explain why the consumer is so resilient and why so many reliable recession leading indicators may be crying wolves. The answer, I think, is the top left chart, which shows the composition of all consumer debt. You can see that mortgage is a whopping 70% of these debts. And as we all know, most homeowners are sitting on low interest fixed rate mortgages. So higher rates and credit tightening are only about 30% effective this time. More credit card accounts have been opened, and delinquency rates for both credit cards and auto loans are rising, but bankruptcies and foreclosures have remained low here. The NAAIM index represents the average exposure to U.S. equity markets reported by members of the National Association of Active Investment Managers. It is a survey of sentiment among professional money managers. Like most sentiment measures, it helps in identify extreme bearishness. And so we reached a relatively low level at the end of October. That set the stage for the November rally here. This slide has two sentiment indicators and a classic volatility indicator. The CNN Fear and Greed Index sentiment indicator is moving upward into the greed range after the rally early November, while the investor intelligence are above normal and still has room to run. As far as VIX is telling us, I think it represents the option traders' expectation for high volatility in the next 30 days. So at 14.32, I think they're not expecting a huge spike, although there's no guarantee. Seems like master limited partnerships, MLPs, are paying good dividends. They would be a good part of an income portfolio, I guess. So here's a price chart of a few MLP ETFs. Now, this one is a Fed survey that takes place every 3 years. Because it's infrequent. That's why you don't see many dots. or data points on the chart. Overall, consumer income, net worth, and assets are up, and debt is down. So it says that the consumer finance is in a healthy state. Again, this may explain why the economy is still strong in the face of these relatively high interest rates. Data on wealth inequality here. It heads up here. Since we just had Halloween, here's some scary charts. The charts on this slide are from Hussman Strategic Advisors, and you can see the URL on the title bar. The two charts on the upper half of the slide show possible dangers ahead in the stock market. Based on their calculations, the stock market return for the next 10 years will head lower, and the risk of a severe correction in the next few years is high. The two charts on the lower half of the slide reminded us of the negative impact on both banks and the Fed when interest rates are dramatically higher. Their unrealized loss on long-term bond is huge, which may be a ticking time bomb. Now, I am not a bond expert. I was told bond market is operated by very smart people. And when you're lending money, which is buying a bond, the interest rate and the default risk are top considerations. Normally, the yield, the interest rate of a 10-year T-note is mostly determined by inflation expectation, since the default risk of the United States government is generally considered to be nil. So when the interest rate of a 10-year T-note is below inflation rate, those smart bond professionals must be expecting the inflation to be transitory. As you can see on the slide, the only prior occurrence of a negative after inflation yield was during the high inflation era of 1974. This was a bad omen then, but it just happened again in 2022. I hope we don't repeat that high inflation decade, since the global environment is quite different nowadays. But it is sort of a wake-up call. The last slide is just for fun. It's kind of interesting if you're into ranking places. So that's all I have. I apologize for the terrible audio quality in the webinar earlier. Thank you. And any questions, welcome.
Well, I appreciate that. And again, we'll investigate what the connection problems were today. But appreciate the content, Gilbert, and a lot of valuable information to be shared there. At this point in the meeting, I'm going to move into the main topic for presentation this week is basically how to invest in the higher for longer interest rate environment that we seem to be in. However, I've got to set the disclaimer there that we have seen we've seen a pretty good bond market rally in the last 10 days or so, because the Fed, as you pointed out, Gilbert, they didn't raise rates. And one of the things I've noticed is that the we've seen a lot of, actually most meetings, it seems that Chairman Powell, the Fed chairperson, Federal Reserve, has come out about a week later and said, well, when people got too bullish about rates coming down and bond prices going up and inflation rate coming down, and he's cautioned investors. He didn't do as much of a convincing job this time, I think, as he has prior meetings. And plus, if people have heard the phrase that the Fed plot or dot plot, that shows where the various Fed members that have voting authority on the Federal Reserve are projecting, and they're looking at rates not moving that much from here. So that got the market kind of bullish too, the bond market bullish. Equities rallied kind of in conjunction with that. We've had a pretty good rally in the last week. And that's partially a function, lower interest rate environment, less of a tough comparison versus buying bonds. And so investors just got bullish here. We'll see if that trend continues, but it was a pretty significant move. However, I'd say that we're, even though we've had a bond market rally here, we're not that far off where we were on the 2-year bond or the 10-year bond versus a couple of weeks ago. And it's important to note that interest rates have moved up significantly, as I'm sure everyone's noticed, the last since early 2022. And even though, where Gilbert pointed out in his presentation that the Federal Reserve, missed the inflation figures there, and the bond market didn't seem to read that as accurately either. And all of a sudden, interest rates were being raised aggressively because the Fed thought, well, they missed their opportunity, and inflation was not transitory, and it was working its way in the system at high levels. At one point, I think we had one of the inflation rates was showing 9%. It's come down some since then, but it's also important to note that even if the inflation rate is coming down, we've already seen the legacy effects of higher inflation embedded in the economy. So that is a factor. We're seeing it a lot of different places. Auto prices, for instance, and you may be able to see food prices come down perhaps, but that's more speculation at this point. And for instance, things like, I've just noticed we got a notification that here in Portland, Oregon metro area, we have the utility Portland General Electric that provides us with our electrical power. Their rates are going up, I believe, 17% year over year. So there's still a lot of inflation areas that consumers feel very squeezed. And that's one of the reasons why consumer sentiment is relatively low, and investors are not feeling that great about the direction of things, despite the fact that we've had a relatively robust economy. And even though we may have, still a chance of a recession, there's also a good chance that we may not actually have one going forward. So I was in with a presentation with some materials here that Veda Phi, that I attend their meetings because I do investment consulting, and they were presenting on the outlook for for the outlook for interest rates and bond prices. And it's important to note that, and can everyone see the chart display that I'm showing here, by the way? I hope that's visible to everyone. And and so what you've got here is you have a situation where interest rates moved up significantly. And if you owned a lot of conventional types of bonds, and by conventional, I mean like US Treasuries and agency bonds and investment grade corporate bonds over the last couple of years, you got hit reasonably hard. I mean, its returns were down double digits in 2022 and are down about low single digits in 2023. And that's a major correction in bond prices that we've had to experience. So it's been a tough place to be. This fixed income sector performance shows those areas of the bond market that got hit the hardest. And the type of risk that has been pronounced that investors have felt is what's called duration risk or average maturity risk of your bond portfolio. And you can see over here on the far left side, I don't know if people can see where I'm positioning my cursor, but we've had long-term treasury rates, which are beyond 20 years, were down about 12% last year, and then are down another 7% this year. So that is quite a haircut. And of course, these are bonds that are considered about the highest credit quality you can have, and yet they really, really took it on the chin here. And the other category that also took it on the chin is over here, 10-year investment grade corporate bonds. They were down 7.2% in 2022, and year to date in 2023 are down another almost 3%. So that's quite a haircut that they took. but you have some other, so you have other areas of the bond market though that have done relatively well. For instance, looking over here, U.S. High yield bonds that have a lower investment grade, BBB or lower, those were actually were up 0.3% in 2022, and they're up 5.8% in 2023. And then senior loans, which are the types of loans that are senior, like it on the balance sheet, that are secured loans that are on bank and other financial institution balance sheets, also were pretty robust. They were actually up 3.5% in 2022, and they're up 10% this year. So that's been a very good place to be. So the point of this slide is really to show that the bond market is diverse, and it makes a lot of difference in what you own. So convertibles, preferreds, loans, and high yield bonds are the top performing sectors this year. And by the way, this is more of an overview of how they've done so far in both 2022 and 2023. And one thing I'll tell you is that we're going to have some discussion of these specific asset classes in future meetings that we're doing here with the income and cash flow special interest group. We're going to be talking about one of those subjects every meeting, but this is initial overview because we wanted to talk about what's done well, what hasn't, where have been the good places to be, and how should perhaps you might want to consider being positioned going forward. I will repeat the same disclaimers that Andy showed at the beginning of the meeting, and also that Gilbert also showed. And this, we're not offering investment advice here. This is informational purposes, but it's good background, and recognizing the context that we're presenting this to AAII members that tend to manage a lot of their own money. So if we go down here and rates and inflation here, and we see that I'm trying to move this out of my viewpoint. So the we're with interest rates being where they are at got up to 5.5% at the peak, and inflation reflecting inflation levels. And with these type of inflation levels, we would expect interest rates to be at these levels. It's also important to note that these are not really long-term abnormal rates. What's been abnormal is the last 10 years where interest rates have been kept relatively low. And they were kept relatively low when we had the Great Recession in 2008 and 2009, and then when we had of course COVID in 2019. They came slamming down again, and so they were close to 0% in a lot of cases. Those were long-term abnormal rates. But I can remember, and older than some people on the call, 5% money market rates back in the 80s and 90s, and here we are again at close to 5% rates. So they're not out of the historical norm. What the historical norm or abnormal situation was what we've experienced during these crises, again during COVID and during the Great Recession in 2008, 2009. So move this down a little further. Bonds are more fairly balanced now. One of the things that happened with the Federal Reserve got so involved with interest rates and credit quality, they were buying up bonds beyond just treasuries and agency bonds, and that's traditionally the only areas the Fed got involved in. They got involved in corporate bonds. They were concerned about an outright credit crisis, and that was a real legitimate concern back in 2008, 2009. And then they were also being pretty darn cautious too when we hit COVID, because that was kind of uncharted territory, and for waiting to see how the markets were going to react in that situation. So the emphasis definitely being on providing liquidity and keeping interest rates relatively low, and or absolutely low, but relatively low based on historical norms. Business cycle. And I won't dwell on this too much because some of this information is repetitive for what Gilbert has already showed you. But we see the trend in rates and what tends to happen given weakness or strength in the economy. Credit trends here. And what tends to happen is again, when investors are concerned about the economy and the economy weakening, that oftentimes we will see credit spreads. And I define that by saying the difference between investment grade bonds like U.S. Treasuries, agencies, and investment grade corporate bonds, and then high yielding bonds and other classes that tend to yield more. But those spreads are relatively narrow. And so what's that's showing us is, well, if we really thought we were going to a recession, we might see a significant widening of interest rate spreads. But we really haven't seen that. They're not out of whack with the historical norms, which is what this shows you here over the where credit spreads are versus the 20-year Treasury bond. And and that's one of the reasons why, again, areas like high yield bonds and senior loans have done well, because investors in the bond market haven't been that concerned with credit quality. They've been concerned about the rising trend in interest rates, which they should be because they've risen so significantly. And okay, so that's another way. This chart, some of this is repetitive, so I'm not going to dwell on it too much, but just showing the credit spreads from another angle. They're relatively narrow. And now how that is true that credit downgrades have outpaced upgrades for 5 straight quarters. That is a trend, and that's not to be dismissed. But the credit spreads are still relatively tight. Part of that is probably due to still a lot of liquidity in the marketplace and a lot of liquidity in the bond market. So for down here, and we talk about ideas for higher for longer interest rates. And so this is something to keep in mind because, and this is, for instance, those of you that own bonds as part of your investment portfolio and you own them in taxable investment accounts, you may have some losses on those. And I'll show you, I've got a future slide that's coming up that will show you the losses in the different categories. You know, it may be a good time, for instance, to take a tax loss on a bond and swap into another bond, which you can do, you know, a similar bond, you know, basically right away. Or if you wait 31 days, you can even buy back into the bond that you sold and still lock in that tax loss for the 2023 tax year. So that's important to keep in mind too. And one of the things that we've seen, and Gilbert referenced this too, we've had an inverted yield curve. We've had where long-term rates are lower than short-term rates. We've had the 2-year rate pretty high. And so so you really haven't been rewarded for extending maturities in your bond portfolio, at least not so far. But that's whether that's going to continue remains to be seen. And so right now they've been pretty good. We're going to talk about those inflection points that people can miss, which could be a real buying opportunity here for bonds to extend your maturities. But we'll get to that in a few minutes. And this talks about going active in the core. In other words, don't just own U.S. Treasuries and agency bonds, and you can even look beyond investment grade corporate bonds. So there are areas you can use, and I'm going to show you a fund that is an example of that uses a variety of different types of bonds in addition to those categories, and utilize hybrids, convertibles, and preferreds. Again, we're not going to go into a lot of detail on those on this call. That's going to be on future calls. But these types of bonds and fixed income instruments can help you manage risk and seek higher yields, and also have been relatively robust and not giving up a lot of ground, as I pointed out in those other slides. So, higher rates, again, can lead to bond losses, tax loss harvesting. This is just another way of talking about that. And So, you know, with you got some bond sectors that are down over 5% for year to date, and double digits for more than 1 year. So keep in mind, you may have some bonds where you generated some losses in a taxable account last year, but you could still take those losses this year if you want to use those to offset capital gains elsewhere in your investment portfolio. And here's an example of this. This print is a little small, so I apologize for that. But if you look up here and go, okay, these core aggregate bonds, there's an index you may have heard of called the Lehman Aggregate Index. Consists predominantly of U.S. government bonds, agency bonds, mortgage bonds, and high quality corporates. And since the start of 2022, that category of bonds are down almost 19%, 18.4%. Broad U.S. investment grade categories, excluding governments, they're down over 21%. If we skip down here, short-term corporates didn't give up that much, 6.4. Intermediate-term corporates, though, were down about 13.6. Long-term corporates down 33%. Those are big returns, big negative returns for bonds, as I'm sure those of you that own those types of bonds have experienced that. So, and that's why you probably heard a lot about, and there's been a lot written about, that the fact that the old 60-40 asset allocation mix with about 60% equities and 40% bonds, or vice versa, was not provide you with much cushioning in 2022, because they both gave up a lot of ground. Equities, which we're not focusing on today, were down 15 to 20%. And again, we're seeing some categories here in fixed income that have been down. If we combine 2022 and year to date, down pretty hefty double digits. So those have been tough places to be. And so again, you may take a look at your bonds in those of you that have bonds that you own in taxable portfolios. Tax deferred vehicles like IRA rollovers and 401ks. Well, there's no tax benefits to taking the losses there, but you still may want to consider repositioning them. So, but those are some pretty big negative numbers. Some of the biggest we've seen over a 2-year period, going back decades. So it has been significant. And again, those investors that were, sitting there last year saying, "Well, I'll be more conservative, I'll own more bonds," but both bonds and stocks were getting hit last year. That diversification didn't help you much. So that's why the 60-40 is getting questioned. That's a subject for another day. You can also make the argument that, well, maybe it will work again because bond interest rates have moved up a lot and you can get higher coupons on your bonds. So that's something to keep in mind as well. Again, another topic for another day. And so one of the things that this pointed out, and I will point out, this presentation was made in October. And of course, we have seen a move, as I mentioned at the top of the when I introduced this topic today. We've seen a fair amount of movement since then, but still we've seen interest rates move up pretty significantly. And I think these numbers, by the way, back on this slide, those returns, those reflect through September 30th of this year, I believe. That's what we're looking at there. So the most recent full quarter end. And then and investors, that we did a lot of movement on the short end of the yield curve when the Fed starts sounding more hawkish, and which they've been doing for most of the last 2 years. And so we will see money market rates react quickly. We'll see short-term interest rates react quickly. And the more in, again, those time periods when the Federal Reserve Chair, Jerome Powell, said, "Wait a minute, you guys were too bullish at the last Wednesday Fed meeting. We're going to keep raising rates as long as we need to." And he keeps saying that. And in fact, he said it the most recent call. But investors they're skeptical now with inflation coming down that they're going to need to raise rates as much or as consistently as they have. So you will get, shorter duration bonds will be more stable, give up less ground. We saw those longer term treasury bonds those 10 and 20-year, and the fact that they were down double digits in previous illustrations, but the shorter term instruments have not given up as much. You're not extending maturity as far, and so they don't tend to be as volatile as the longer term bonds do. And that's what this chart purports to show as well. And this is, by the way, and one of the things that to keep in mind here is that when you get an inflection point in interest rates and correspondingly in bond prices, like we have experienced the last 2 years, that is a time when you can be better off owning actively managed bond managers in funds that can reposition. Of course, you can buy individual bonds too. I prefer to use skilled managers to manage my bond portfolios for me, but that's an individual preference. But it's also true that in some asset classes like preferreds and things like that, floating rate bonds and things, managers can get much better pricing than you can if you buy individual bonds. But what it has been shown is that we've seen a high percentage of actively managed funds that have outperformed their benchmarks because they have repositioned smartly. You see, for instance, in this column, the second quarter of 2023, 77% of short-term, or excuse me, ultra-short bonds managers less than 2 years outperform their benchmarks. 81% short-term, intermediate-term 60. Anytime you get a majority of managers outperforming their relative benchmarks, that's really solid performance. And it shows you that if you got position versus just sitting there in a static portfolio, and a lot of investors have done that for long-term trends, owning passive investments. You ride the trend, keep your fees down, but that can work very well, and it has for a lot of the last 20 years, quite frankly. But when you get an inflection point like we've seen with a shift in interest rates that's been so significant over a relatively short period of time. I mean, the Fed rates so quickly, so aggressively last year, starting out, and again this year too. Those are major moves in a short period of time, and that's a time period where it can help to have active manage. And I will admit, I have an active management bias. A lot of people don't, but I just put that on the table. I look for excellent managers and get the best ones I can find because they do this full time, and which I used to do, but I'm not doing full time any longer. And so that can show you that's pretty dramatic that you've benefited and more than earned the extra fees that you're paying with higher returns by having active managers if they were in fact managing a portion of your bond portfolio. So this is an example of a fund. It's called Go Active in the Core. And as I mentioned, most bond funds, conventional bond funds, will have agencies, U.S. Treasuries, U.S. agencies, investment grade corporates. This is a more diversified fund, and this is not an advertisement for this fund. This is a fund that they used as an example here. This is the total, which is a exchange traded fund. It's actually run by Jeffrey Gundlach. You may have heard his name. He's kind of been dubbed the new bond king since Bill Gross kind of retired, and has a very solid long-term record, and is an outside the box thinker. I'll disclose I'm a fan of his, and because he always has interesting things to say, and he's right more than he is wrong. And he owns a variety of different asset classes in this fund. These are small letters, so you may not be able to see them as well as I'd like, but here's collateralized loan obligations, 3.8%. These are adjustable secured loans at 3.5, high yield corporates 3.3, emerging market debt 2.4, bank loans 2.1%, and the rest of this is positioned pretty conservatively. Investment grade corporates 8.2, non-agency mortgage-backed bonds. I know he's bullish on mortgage-backed bonds. He's been talking about it for a long time this year, and so he's got that's the biggest overweighting in his portfolio. So And it's worked pretty well for that particular fund. Again, this is not an advertisement for this fund. It's just a well-known fund, and Gundlach's got a good long-term track record and a habit of being right more than he's been wrong. So it's probably a good example of a diversified fund to use. And also this fund is, and obviously when they made this presentation, they're representing the Double Line Fund, which Double Line is the name of the firm that Gundlach and his team work for. And TOTL is the symbol for this. And this tends to be, have relatively low volatility compared to other bond funds in this category. And that's because they are predominantly because they are more broadly diversified. And as I mentioned, they own some categories that have been relatively robust this year. So these are other examples. If you want to go the passive route, now it's 59 basis points for this total fund. Check the expense ratio on this. If you want to own SPDR portfolios, and this is the organization that made this presentation, backs the SPDR funds. They're a major issuer of exchange traded funds. And here's a fund portfolio you can put together with an expense ratio of 3 basis points. That is cheap. It's passive, and you don't get that active management, but you can put together your own portfolio at a very low cost. And so it's a good comparison, 3 basis points versus 59 basis points. Then you can do other things like adjust your duration, your average maturity, and make some other adjustments. Target hybrids, I mentioned convertible bond funds, which we'll talk about on a future call. That's a way of owning they've been described as chicken stock funds, where you actually can have a relatively defensive oriented participation in equity fund that also has above average yields. But that's a topic for another day. But convertibles have a lot of potential, and they've performed pretty well here. And so we'll be, again, describing those in more detail on future calls. And here's a blend hybrid. We're using convertibles, preferred securities, other hybrid investments, and sector diversification to get to put a portfolio together too. And a lot of these categories, again, have done relatively well compared to particularly longer term or even intermediate term governments and corporate bonds. So, and down here, this lists the performance of these various SPDR funds, the actively managed and the not actively managed funds, but I won't go into that in detail here. I did want to point out, I'm going to switch to a different presentation for a couple of slides that I want to be able to show you. And let me see if I can get back up here, get to the right place to do that. So what I'm going to do is I'm going to stop sharing temporarily, and I'm going to seek to pull up this other presentation. So let me go to here. I'm going to share the screen. And if this works like it did in the practice session, we'll find this. Okay, now let's see here. Where was that? Hang on a second. Oh, here it is. Let's see if I can go back and activate this. I may have to ask our skilled webmaster, who I forgot to introduce, John Wong, who's the webmaster for our chapter and is much more skilled in this than I am. But I'm going to try to see if I can bring up that file here. Let's see. I have this over here. I just got to bring it over into the main screen. Okay, let's see. John, I'm having trouble bringing this one onto the screen. I don't know if there's a way we can get it over there. It's just a PDF document, but it's not showing up on this page. Oh, here is it down here. I don't know if you're seeing it.
No. So click on share screen at the bottom.
Yeah, well, I think I need to get over to that other page to do that. So, oh, okay. Well, hang on a second. Oh, okay. I'm gonna share screen, and then I've got, but this, oh, no, here it is. I think it's here now. Okay, let me try that. Share. Okay. Okay, I think it's showing up. Are you seeing that holding bonds with longer maturities, John?
Yes.
Okay, good. Okay, this is this makes a little bit of a counter argument, because what we have seen now is that I mentioned it earlier in the presentation. I said, okay, we've seen interest rates move up significantly. We have seen a pretty decent bond market rally the last couple of weeks, but interest rates are still a lot higher than they were 2 years ago. And so this is, and normally what happens is it's really, a lot of investors miss the inflection point, with, you know, the change in the market direction. And so, but I personally don't think, and again, not giving advice here, but that we have, there's still room to reposition bonds so that you're not perhaps too short. Because one of the things, there's a lot of investors that have been sitting in money market because, hey, again, we haven't seen 5% money market rates in literally decades. And so a lot of people are just sitting, well, I can get 5% with no risk. And it's true, you're not having any average maturity or duration risk like those 10 and 20-year bonds were showing. But at the same time, if rates are going to come down here and the Fed is close to being tightening, this could be a good time to extend maturity a bit and not be sitting there in money market, because your money market rates will be the first rates to drop as the Fed makes adjustments. And that may not happen right away, but it's worth taking a look at. And so if we look and move down here, I'm just going to show you a few data points here. That in what happens is, and this says cash or money market, those terms are used interchangeably, tends to lag when the Federal Reserve stops hiking rates. And so that means that, okay, your money market rates are going to drop pretty quickly. And so you're not going to get any appreciation there. Not only that, but you're not going to be able to enjoy that higher yield for very long, because rates are going to come off. And so here's is an example of why investors, they list 3 reasons, and this is a different source than I listed before, but I thought it's a nice outline. Just came out today, as a matter of fact. Markets anticipate 3 reasons why investors should consider extending maturity in your bond portfolios. If the markets are starting to anticipate the Fed's actions in not raising rates, it's important to keep in mind the Fed doesn't just go from, okay, we're done raising rates, then we start cutting them right away. There's generally about a year lag before they start to do that. But the markets are anticipatory, and so they'll start to reflect that. And you might have heard the phrase, well, sometimes the bond market will do the Fed's work for it. They'll be preemptive. They'll adjust in advance, and that can happen. And so in a situation like that, you could see that, okay, if the bonds market is already starting to move, and whether this move is sustainable that's happened the last week or so, I don't know. But we've got, but we have seen the bond market started to rally. And you still have many bonds selling at a discount, and global uncertainties may push rates down and bond prices up. So you can see that people may buy up those bonds at a discount to par and say, well, I'll enjoy those. Those are lower prices. I'll take advantage of that. And then, there's still other factors. The Fed doesn't operate in a vacuum here. There's worldwide conditions. The U.S. economy, which has historically been the norm, has been outperforming international economies and emerging markets economies. For instance, they were discussing a lot in the press this week about the Chinese economy, which isn't as strong as it's been. And Xi Jinping, the president of China, was here yesterday meeting with Biden and other representatives here in the U.S. to talk about, well, let's work together to get the economies going. Of course, the Chinese economy has been a huge economic driver for decades. So if it remains slow, that could have a significant impact on the worldwide economy. The rest of the world has benefited a lot from the growth that China has generated during those previous decades. And again, so markets can anticipate the Fed's actions. I won't read all the text here, kind of briefly summarized it. And then what you have here is, here's a good chart that shows intermediate duration has tended to outperform short duration bonds and cash 1 year after the Federal Reserve hit rate hike, based on history. And we show 5 different scenarios where we'd seen the Fed adjusting interest rates, and so in other words, these cycles had ended. In other words, the Fed was raising rates until February 1st of 2096. And what happened is intermediate term bonds rallied at that point, year over year, being anticipatory, 16.8%, major move. Short-term bonds, 10.4%. Cash or money market, 6.4%. That's still a nice move, but not nearly as much as intermediate and short-term do. So that's important to note in these examples. So you were better off in intermediate term bonds in really each of these cases here, where the Fed was done raising rates and so investors are going, I'll go out on the curve now and enjoy those yields, lock them in before they drop. And that's what they did. So you did better for intermediate than you did in short-term bonds, and you did better in short-term bonds than you did in cash or money markets. So, and again, past performance does not guarantee future results, but this is historically what has happened during the previous 5 interest rate increases, and they ended at these points in time. And we don't know, again, we're speculating right now as to when the interest rate increase trend will be done for this cycle, but we might find out sooner rather than later. So, and again, as I mentioned that, I guess it's 11 months. The Fed has held rates steady for an average rate of 11 months, but that doesn't mean the bond market stays steady. That just means, remember, the Fed has historically just worked in money market yields, and the rest of the bond going out 3 months, and the rest of the bond market has reacted however they want to react to what the Federal Reserve has done. So you'll see that, but it does tend to be anticipatory. And if it looks like the Fed is done raising rates, we're going to see interest rates come down further out on the yield curve to reflect that. Doesn't mean it's necessarily going to happen, but it historically has happened if the Fed is done. And again, we don't know that they're done, but there's some signs that they're definitely closer to the end of this tightening cycle than they are the beginning. I think that's probably a safe bet. And here's where 10-year treasuries have reacted between the last rate hike and the first rate cut. And so that's, you can see how they have reacted over that time period. And so what you're seeing is interest rates did come down during this first, and these are the same cycles we were looking at in the other chart. Starting rate for a treasury in this case from February of 1995 to July of 95, we saw interest rates on 10-year treasuries decline 1.6%. They went from 7.6% to 6%. And that's only 6 months. So that's a pretty short period of time. And again, remember, the Fed historically hasn't done anything for a year after they're done tightening in terms of easing credit, reducing interest rates. But again, the bond market will tend to be anticipatory. And so those were pretty good moves for short-term periods of time. And of course, these are not uniform periods of time. This example, this is 97 through, this is March of 97, the second box, through September of 98. So that's basically a year and a half. And the rate change percentage terms from 6.76 to 4.57, that was 2.2%. So a pretty good move over that time. And again, people will tend to buy bonds at discounts, and because they can hold them till maturity and lock them in, and bond fund managers will do that too. So they can take advantage of that. So that's something else that can contribute to bond returns. And all of a sudden we had bonds that, 2 years ago were selling at par, or even premiums. They're selling at discounts now because they're worth less, because interest rates have moved up, their prices have gone down, and their income stream isn't worth what it used to be. So those are examples. And again, the Federal Reserve does not act in a vacuum. Global uncertainties, other issues overseas. And here's that chart I meant to show you earlier. The three biggest components of the Lehman Aggregate Bond Index. Lehman Brothers isn't around anymore, but the index still is. And you can see U.S. Treasuries, 41% of the portfolio. U.S. government agencies, 26%. Investment grade corporates, 25%. And so those are the more conservative investments. And again, for instance, that double line fund that I showed you, that was more broadly diversified than an aggregate bond index. And there's a lot of bond funds that are managed to emulate or mirror as close as possible the aggregate bond index. And so you can see only 3 categories of components here. But again, these have not been the best performing categories over the last 2 years, which is why a more broadly diversified bond portfolio and bond funds, and the double line is one of them, did better than just sticking to the most conservative investments. Again, there's different types of bond market risk, which I should have done. There's actually 9 different ones. I mean, one is inflation, purchasing power risk. I focused on interest rate risk because that's been the biggest factor in risk in the bond market during this close to 2-year time period, because rates have risen. That's been the primary movement. But there's reinvestment risk, reinvesting at a lower rate, credit risk, if the credit markets, if those spreads start to widen, liquidity. We've seen liquidity constraints when we've had uncertainty in the bond market in the past. We saw that in 2007, 2008. And you might even have default risk. So there's different categories of risk, but interest rate risk, and you should pay attention to all of them, and your bond manager does. But what's been the biggest factor, because we haven't been in a recession, but interest rates have moved significantly, is interest rate risk is the biggest risk in terms of impact on bond portfolios that investors have experienced over the last 2 years. So that's basically what I wanted to show you on that chart, because this is more recent and it reflects changes that are going on in the bond market as we speak versus looking at the quarter end data. And to sum up, it's you look at this and you go, okay, where can I what type of positioning opportunities are there out there? And again, we just kind of gave a brief summary of those categories that you can use to broaden your asset mix in a bond portfolio. But we're not going into detail on those specific types of bonds. But we intend to on future calls. So we're going to have different topics for each of these meetings, as well as have follow-up discussion and deal with any question and answer that that people might have from previous meetings. So once we now that we're getting going in this new format, so that's pretty much the data information I wanted to share with you. And if we have any questions, let's see, I can see the chat box here at the top of my head. Let me see what we've got here. Let's see here. Okay. Size your slide. Okay. 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 All right. Future market returns. Says there is an answer on one of Andy's question. A question on the personal view of future market returns. A lot of the value investors are negative about future returns, and but they can make decisions based on that. So I don't see a lot. Let's see if there's any in the Q&A box. Oh, just a question, a reference on handouts. And we can, I think that we can probably make these handouts available when we, because we're recording this meeting, right, John? And then this
Yes.
information will be posted.
Yes,
Okay.
your slides and Gilbert's slide can be posted on the website.
Okay. Okay. Good. So they'll get there when we have various compliance things we have to do before they get there. And let's see, we have participants that I think raised their hands according to this. So let's see if I can pull those up. Did I miss something here? Okay. Okay, Kenneth. Okay, Kenneth Maxwell, I think. Did you have a question? You're still on the call. Let's see. And you have to take yourself off mute if you're muted. And then I'm not sure where else I can see hands raised on this display, John. But I think most of the questions were put into the chat room. And you can usually use the chat room or Q&A section for that. But does anybody else have any questions they'd like to ask? If so, that we didn't cover, take yourself off mute if that's the case, and we'll try to do our best to answer them. And I'm going to stop sharing. I have to stop sharing button because I don't have a screen to share here going forward. But so let me know. Okay, here's a Q&A. Okay, the question is, so where is the website where the handouts will be? John, that's the PDX site,
Yeah,
right?
yeah. So we have to go through a compliance process. If those are clear to post, the website is AAIIPDX.com, and there's a page on resources, and the handouts will be there.
Yeah. Thank you. And let's see. Any other questions? Be the time to ask him. And we're pretty close to actually our target time, to maximum of about 90 minutes. We're pretty close to that. And we again, we'll be doing the meetings. We're going to get Gilbert's microphone was broken there. We're going to get a replacement for that, so it'll be much clearer on the next call. And I think we're going to be talking about preferred stocks at the next meeting, but we have to clarify that. And but we encourage people to come on the next call too, which will be, and that date will be December 21st. Again, a Thursday, I guess before Christmas, at 4 p.m. West Coast time. That's 7 p.m. East Coast time, and we'll be presenting then, and go from there. So, and hopefully people are aware of the income investing site nationally, where some Q&A goes, and including our discussions from these meetings. So that's available too. Maybe we can send out some follow-up information on that for those of you that may not be aware of that. But we do have a national site for discussion on income and cash flow oriented investments that actually Andy was set up to be the original chair of. And I'm sure you got a generous compensation for that, Andy. No, I'm kidding. None of us get paid for that. But let's see if there's any other questions. Okay, a couple other questions I see. What considerations are good in determining to sell long-term 42 years bonds that have dropped significantly? Yeah, that's a good question. And I don't know, this is from Paul Harms. Paul, if those are government or corporate bonds. But I think what you probably do is get a bid on them. And I frankly, that would probably depend on what kind of interest rates you're getting on those. Obviously, no matter what rate you have, it's probably the value of your bonds has dropped because we had such a significant pickup in interest rates. And so, okay, you say it might be 24 years. That can make a difference, but I think it depends on, I assume you probably have a brokerage account with one firm, and you can get pricing on those bonds and see what their bids, and then decide if you're willing to, if it can be advantageous to take a loss. And of course, as I mentioned, it depends. Could depend also on whether you're in a taxable or a tax-deferred investment vehicle that you own the bonds. That can make a difference as to whether it's advantageous to take a tax loss. And you can argue that, okay, well, the bond market is starting to rally here. You could see if it rallies further, get closer to year end and see where you're at. But that can be a little tricky. But I'd start by getting just getting a bid on the bonds and taking into account if you're using the income, if that's important to you, the income stream from those bonds for your immediate needs, that can take into account too if that coupon is attractive. So there's a lot of ifs there, realize, because I don't have more specifics, but I'd start by getting a fresh bid from your brokerage firm, which you could probably do online, and see if it's advantageous to look at making a move there. Or perhaps you've got you mentioned you've got more than one bond, so you might hedge your bets and consider selling one of them and keeping another. So, because I mean, it is difficult to predict short-term interest rates. Let's face it, not an easy thing to do. So, thank you for that question. And okay, well, appreciate everybody calling in today and listening to the presentation.
Todd,
Go ahead, go ahead, Andy. Yeah.
I just wanted to mention a little logistical thing. The people who were listed on the Google Groups website that we used for announcing meetings, we're going to transport all those email addresses over to the site that John Wong maintains, so that you can get future announcements on these meetings. And then after we have done that, probably we'll wait maybe a month or two. We're probably going to shut down that Google group, because there's no sense in having redundant email addresses. And so just be aware of that. You know, if you want to, you're starting to get emails from both sources, because we'll shut down the Google group here probably within the next couple of months, you know, after everybody's comfortable with the new site. So just be aware of that.
Thank you, Andy. Okay. All right. Well, I think we're going to sign off here. Just gone about 90 minutes. So, and again, appreciate everybody participating. Please spread the word for others that you may know that may be interested in calling into our future meetings as well. And we look forward to seeing everybody hopefully in December. That's Thursday, December 21st, again at 4 p.m. Pacific Coast time. So